Hello traders, today is the 20th of January. My name is Devil Hornsey, market actually trading. And today we're looking at the S&P 500. Okay, this is the weekly chart of the S&P 500. And you can see that from March 2020 all the way up to the beginning of this year, we've had a meteoric rise from the lows of 2,181 all the way up to 4,816. So it's been a massive bull trend. And the reason we're looking at it today is because if we go to a daily chart, we're approaching quite a significant swing low. Now, the swing low printed on the 3rd of December 2021, and it comes in around 4,493. And currently the price is at 4,549. So, a couple of 100 points to the downside. And then we'll be into a different type of market structure where we, if you look back through the last 18 months, generally the significant highs and the significant lows are going higher. We did have a little blip in the 30th of September 2021, and we could get a similar sort of reaction if we do have a look below this swing low. You want to see prices get back above the next swing high. So if that was to happen, we'd need to get back above 4,750 quite quickly. Otherwise, we're going to be looking at a sort of lower S&P 500 going into the midterms, which happens around October this year. Now, the reason for looking at the S&P 500 today specifically is because a year ago today, President Biden was sworn into office. Obviously, he won the election in November 2020. But it wasn't until the 20th of January 21 they actually took the helm. So he's had a whole year in office, and so far so good. The stock market has potentially been up to 25% higher, and is currently around 18% higher. So President Biden's first year, wasn't detrimental to the stock market. Generally, the second year of a presidential term is the most damaging to the equities, basically because all the goodwill that was pumped into the markets pre-election to try and sort of buy up some voters. Obviously, you get like tax breaks, stimulus and things like that. That all gets spent and burnt through. And now, just looking at the news headlines, you get to see that, the stimulus itself is not forthcoming. The Build Back Better is being put on hold, essentially. We've got Federal Reserve looking to raise their rates. So corporate earnings, even though they're good at the moment, we're in corporate earnings season. The forward guidance is that earnings will be hit as the sort of next couple of quarters goes along. Some of that is inflationary pressures from wages. Others will be the worry of raising rates, which then impacts on the high levels of debt that corporates generally have. So, until we actually take out the swing low, and then maybe if we were to look for a look below and then get back straight above like we did in September, that could just clear out some weak hands. And then, yes, possibly we could go and take out the swing high and all-time highs. However, because this whole period of time, if you like, is completely different to last year. And obviously the beginning of this actual move, there isn't stimulus coming in. There is, taxes are taking money out of people's pockets and out of their bank accounts. And if I just actually share another screen. So here I've actually got the fiscal flows that I monitor. The US produce a report each day, which lets you track the fiscal flows on a daily basis. And you can see here that the gray line is the current fiscal flows, the average 10-day flow. And we just had a bit of a dip in the last couple of days down, as we did the previous year, January 21. This is because of a big tax payment that needs to be made. And obviously, when there's a tax payment, people need to sell things like equities to make the cash, to make the payments. So that's part of the reason why we've had a bit of a sell-off in the S&P 500 recently. Going into sort of larger detail, there's a deficit and surplus that the US Treasury has. And when President Biden took office this time last year, the yearly sort of fiscal year, which starts on October the 1st of each year until January 2021, was up at 3 trillion. So there was a fiscal surplus of 3 trillion for the fiscal year so far. And on this date last year, on a monthly basis, there was a 76 billion surplus. If we look to today's figures, we're down to 1.3 billion on the month surplus, and we've dropped from 3 trillion down to 476 billion, almost 477 billion. So a massive decline in how much surplus cash there is floating around in the actual system. Not only is there less cash in the system, the Federal Reserve obviously on about reducing their balance of their assets. And with the rate hikes, the whole monetary sort of policy will be tightening. So as you can see, when you put lots of money into the system, you get a big 45-degree angle sort of raise in the equities. And if you start removing that, I'm expecting to see not necessarily a big correction, but maybe more of like it used to be, where we have a correction and then a grind and the sideways and then a bit of a pop every now and then. So I just don't think we're going to get this meteoric, doubling of the price of equities, because there just isn't as much money coming in. But yeah, going back to what happens in the next few days, if we do get like bad earnings from Apple and things like that, then, we should expect to see a break of market structure. Then what I'd like to see is a classic retest where we break and then go back up, test this old support, see if it becomes resistance before a further continuation to the downside. Because of the amount of bullishness that's been in the markets, these guys selling are probably the actual bulls taking profits. Whereas, we want to see the bears step in if we want to sort of see lower prices. And the bears, if they want to step in, they're going to want, the best price possible. So if they don't test the all-time high sort of swing highs here, the next logical place for them to sort of try to short would be in this supply zone here, in between 4,706, 4,730, and this swing high. So, for them to get that could be like a 61.8% retracement on the fib, depending on how far below the swing low we get. And then we'd be looking for a larger sweep to the downside, taking out some of these more significant swing lows. So below 4,300 at least, maybe all the way down to 4,000. So that's what could happen. And like I said, if there's less money in the system, less money going towards the corporates, it sort of seeps out of the fiscal sort of system into corporate profits. But if there's less money that could just be delivered to these corporates via that channel, then they're going to struggle probably to make bank, because retail sales are down, like we've seen. People are worried about inflation, and the whole system is going to be changing over the course of the next year. Okay, that's my sort of analysis of where we are at the moment. Obviously, if we do find some buyers at this level and then we start taking out these swing highs, it's just keep buying the dip. But be warned of this level here, 4,493 on the S&P 500. If that breaks, then we want to see the initial reaction, whether or not it's a big dip down or whether it's a sweep below. And then we start looking up here, 4,700. I hope that makes sense. And I'll speak to you again.